Mr. Treasurer, on behalf of Fitch Ratings, I'd like to thank you for your time to share your perspectives on Australia's economic outlook. So to begin with, why don't we ask you about your take on the economic outlook? Australia has been relatively successful, we'd say, compared to some of its peers. The contraction last year was modest, and by all accounts, the latest indicators are showing the economy and the labor market improving rapidly. What's your take on the outlook? Is that going to continue?
Well, Stephen, we're very optimistic about the economic outlook here in Australia. As you just said, the contraction last year was much smaller than other comparable countries around the world, with the contraction at 2.5% for 2020. Now we're seeing nominal GDP growth at 3.75% in 2021. We're seeing inflation come back to the band, the 2 to 3% band between 22, 23. Importantly, we've seen our labour market strengthen. Last year, like many other countries, we feared a massive spike in unemployment. And yet that didn't eventuate, with our unemployment now rate falling to 5.5% in the most recent data. So of the 1.3 million Australians who either lost their jobs or saw their working hours reduced to zero during the pandemic, in net terms, all those jobs have come back. And ahead of any major advanced economy around the world, Australia now sees its employment levels above where they were pre-pandemic. 40,000 plus more people today in work compared to when we went into the crisis. And that's very pleasing. Particularly also, it's been full-time jobs that we saw in the last month, 33,800 full-time jobs. Consumer confidence is strong at the highest level in more than a decade. Business conditions are at the highest on record. We actually got some capital expenditure data from the Australian Bureau of Statistics for the March quarter just today. And we saw capital expenditure up by more than 6%, which was the biggest single jump in 9 years. And yesterday we got some data about the construction industry, and new home construction was at its highest level in 20 years. So the data is very positive. Motor vehicle sales are strong, housing starts are strong, consumer confidence is up, business conditions are strong. But like every other country that you deal with, Stephen, we're very cognizant of the fact that we're in the middle of a pandemic. There is still a virus that is raging around the world. We have been very successful in suppressing the virus here in Australia. Tragically, we've had 910 lives that have been lost. But on comparable terms, that's a much smaller number than compared to other like countries. In fact, if we had seen a loss of life here in Australia that was consistent with the average across the OECD, Australia would have lost more than 30,000 souls, not the 910 that we've seen. So both on the health front, where we continue to suppress the virus, and on the economic front, where our labour market and consumer and business confidence has rebounded strongly, we're feeling very optimistic.
Okay. Now, on the vaccine front, which you mentioned, there's a narrative that Asia Pacific and Australia included did very well in the early phase of the pandemic, as you described. And yet the vaccine rollout, which is picking up pace in Australia, we could say lags behind some of the advanced economies, particularly in the West.
Well, it's definitely gaining pace. More than 3.9 million people have now received doses have been distributed across the country already. Importantly, we're focused on the vulnerable populations, Stephen. So more than 50% of those aged over 70 have received at least their first dose. And when it comes to aged care facilities, 97% of them have seen doses distributed already. We have about 5,000 contact points around the country, which is GP clinics as well as large state and territory-run clinics where people are getting the vaccines in large numbers. We have unlike other countries, a sovereign vaccine manufacturing capability here in Australia with a company called CSL, who are making the AstraZeneca vaccine under license. But we've also secured access to the Pfizer vaccine, as well as others. So we've secured access to 170 million doses, which is a lot of doses for our country, including mRNA doses with Pfizer and the like. But we're also providing the vaccine to our neighbours, including in the Pacific, because they've also got some challenges as well, and they are important partners for Australia.
Any target date by when you might achieve that so-called herd immunity level?
We are not putting a specific date on it. What we're saying is that we're moving as quickly as possible to roll out the vaccine. We had in the budget an assumption, and it's important to underline it's not a policy decision, it's a working assumption in the context of the budget, that the vaccine would be available population-wide by the end of the year to all those who wanted the dose. In Australia, it's no different to other countries like the United States and elsewhere where you are seeing a bit of vaccine hesitancy by some, but we are running a communications campaign to encourage everyone to get the jab. Yes.
And are you worried, that the closure of the border might leave some lasting effects on your growth prospects if would-be migrants just simply can't get into Australia? So when should we expect Australia's borders to reopen?
Well, Stephen, as you know, the three drivers of economic growth are population, participation, and productivity. And you're right, Australia has been a wonderful success story in terms of welcoming migrants from around the rest of the world, and will continue to do so. We have seen population growth fall dramatically in this pandemic, not unsurprisingly because of the border restrictions, which we moved very quickly and decisively last year. And that was one of the reasons why we were able to keep the virus at bay, because we were able to close our borders. We have said again in the budget, it's an assumption, not a policy decision, that the international borders will gradually reopen from mid next year. But obviously we will take the medical advice, as we've done throughout this pandemic. We have said with respect to international students, which is an important cohort here in Australia, that we can start taking them earlier than that, and that we could foresee a situation where they come in later this year. We've already started to see small cohorts of international students. What we've said to the states and territories is work with the universities, come up with a plan, get it ticked off by the chief medical officer, and have cohorts of students that come in over and above the state quarantine caps. And if they do that, then that will be favourably looked upon by the federal government in giving approval. So that's where we're at. We'd welcome more international students coming in accordance with those arrangements between the states and the territories and the universities. With respect to international borders, at this point in time, we're saying gradually from mid next year. But again, the situation's so fluid, we will continue to take the medical advice.
Okay, so mid next year is when we might expect to see the borders reopen. Does it worry you maybe that Australia will lag behind then the reopening, say, in the US and Western Europe?
Well, there's two things I would say to that. Firstly, we make an assumption that that net overseas migration starts to pick up and go positive then. So we will rebuild pretty quickly the numbers that are starting to come back from around the world, and we have assumptions and numbers in the budget to that effect. But we make no apology at the same time for continuing to put the safety and the health of Australians foremost in our minds. And what we're doing in this budget is continuing to do the things that have worked to date. And one of the things that has worked to date, and one of the reasons why the economic recovery has been so strong, is because we've suppressed the virus. And so we are running an effective quarantine process. We're looking to expand that. We've just invested $500 million to expand the facilities in the Northern Territory. The states have also got proposals that they're working on. So we'll continue to invest in the quarantine process, but we want to ensure that the safety of Australians come first.
Okay. And I guess that means from time to time, when there are new outbreaks spotted, you're going to need to move in quickly then to address that. And that could be something of, I guess, a headwind to an otherwise strong rebound.
Look, what I'd say to that, Stephen, is that we have, again, put an assumption in the budget that while there'll be outbreaks, because we, of course, don't have an elimination strategy, we have a suppression strategy. There will be outbreaks, but that they won't lead to extended lockdowns. We saw one extended lockdown in one state last year of Victoria, and we are working on the assumption that states have improved their contact testing and their tracing systems, and that we will be in a position to suppress the virus and to localise the outbreaks. I point out to you that Australia's largest state is New South Wales. And even though they've had outbreaks, they haven't had a statewide lockdown over the course of the last 15 months. They have very much been a leader in showing how it's to be done.
Okay. Now let's turn to one of our favorite subjects as a rating agency, which is the budget. You know, Australia is at AAA, one of 10 economies that we rate AAA across the globe. So congratulations on that. But we do have a negative outlook on Australia because of the rapid rise in the public debt ratio and some uncertainties we think about the medium-term trajectory. You've been very active when it comes to fiscal policy. By the IMF's measures, Australia's fiscal response has few peers that are larger. It's among the highest when it comes to as a percent of GDP since the onset of this pandemic. So what's been your strategy? And tell us about the key elements you'd like to highlight in the forthcoming budget.
Sure. Well, obviously, it's a strategy that has worked. And that's really important to underline. We set ourselves some principles going into this crisis, that our response would be temporary. We wouldn't bake in long-term spending to the budget, that we would use existing systems, in particular the existing tax system or the welfare system. We wouldn't try to reinvent programs or systems, so to speak, that our response would be proportionate and that they would be also scalable. And a very good example is what we did with the JobKeeper program, which at around $90 billion was our single largest economic support program. That was an economy-wide wage subsidy, which started at $1,500 a fortnight, and that was provided regardless of the number of hours people worked. And the whole idea behind that, that wage subsidy was when the crisis really reached its zenith, its peak, that we would maintain a formal connection between an employer and employee so that they could effectively hibernate the business. They could get an agreement with their bank to defer repayments. They got an agreement with their landlord to defer rental payments, and that they could get support from the federal government to keep their staff on a base payment of $1,500 a fortnight. And that was a remarkably successful program. But what we did do is we tapered it. So initially it was for 6 months. We extended it to a full year, but we brought that rate down from $1,500 down subsequently to $1,000, but we also introduced a two-tiered payment then based on the number of hours that were worked. And what we saw was the number of people and the number of businesses come off JobKeeper steadily until the program ended at the end of March. And some people said that there would be a cliff at the end of March and the unemployment rate would spike, but it didn't. And that's because we tapered it, and that's because the overall economic settings are very strong. So what we've sought to do in this budget is to end those emergency payments like JobKeeper, but to temporarily extend some of the programs that have worked, and I'll mention just a few of them. One is a low and middle income tax offset, which is focused on people who earn primarily between $48,000 and $90,000, and that they would get up to $1,080 tax relief at the end of the 21-22 financial year. And because of that income threshold, they tend to have a propensity to consume. And so that money gets spent across the economy. Effectively, it's a stimulus measure, but it's into 21-22. We continued that, but it's not baked into the budget. Secondly, we extended the immediate expensing and the loss carryback provisions, which enable businesses, in terms of the immediate expensing, to write off plant, equipment, machinery that they purchase, regardless of the value, all in year one. So from a budget perspective, it's really just a timing issue because it's bringing forward that investment that would have otherwise been the case, Stephen. And they would have had to depreciate it over a number of years. Now they can do it over in year one. And as you know, during recessions, you normally see a capital strike from businesses where they put their hands in their pockets because they're nervous and they're risk averse. Not in this case. In Australia's case, we've actually seen a big jump in spending on investment and machinery off the back of these incentives. So I think that not only creates jobs in the short term, but it also creates productivity gains in the longer term. The loss carryback provisions are basically enabling a business that makes a loss today to carry it back against taxes paid on previous profits and to get a rebate from the government. Again, it's a timing issue for the tax system, and it just means that their losses today, they can get a rebate, which adds to their working capital, which then they can reinvest in plant and equipment and machinery. So those programs are working very well. Another couple of things that are temporary in nature are infrastructure spending programs. We've sought to focus both on long-term major projects across states, but also shovel-ready smaller projects that we can work with local governments and state governments. We have a 10-year, $110 billion pipeline, and in the budget, we injected $15 billion into new infrastructure spending. The other set of initiatives are around skills, particularly focusing on apprentices and others, because you haven't got the flow of international migrants coming or skilled migrants. There's even an added reason to move people through those training programs, and they've been very successful. And there's been a huge take-up across the apprenticeships, and I think that's going to set Australia up very well, whether it's in the construction industry or the hospitality sector or the retail sector. We're putting a great focus on digital transformation, cyber skills. There's a great need in the care workforce as more people come onto an ageing population, to aged care or disability support and the like. So this budget has a significant focus on job creation, and it's through temporary measures that continue what has worked to put us in the position we are. And I just want to mention where we think the jobs focus will take us. As I said, 5.5% is our unemployment rate today. We want to drive that to where it was in February of last year, which was 5.1%, and then even lower still. And in the budget, we are forecasting unemployment to go below 5% by the end of next year. Now, you have to go back to 2006, 2008 to see a sustained unemployment rate below 5% in Australia. And then you have to go all the way back to the 1970s. So we're really being ambitious, Stephen, with respect to driving unemployment down. And this has a budget benefit because it leads to increased tax receipts and lower welfare payments. And we're actually seeing our unemployment bill, if you like, welfare payments for unemployment measures, come down very substantially over time. So we're all doing this while maintaining I think, a strong budget position. Our net debt to GDP peaks at around 40%, our gross debt to GDP around 50%. As you know, that's a fraction of the United States, the United Kingdom, Japan, and other comparable countries. We've taken a very conservative approach with respect to the prices of our largest export, namely iron ore. Iron ore today, as you and I are speaking, is trading around $170 a tonne, free on board, US dollars a tonne. We are saying in the budget that will come down by March next year to around $55 a tonne. If it does remain elevated at above $150 a tonne till then, that will be worth, at least $12 billion to our budget bottom line. So we have been conservative about our commodity forecast prices. We have been prudent with our spending to be temporary in nature, and we're focused on what not only creates jobs, but long-term productivity gains.
Okay, very interesting. So a focus on keeping the momentum going, but focusing at the same time on some of those medium-term productivity and growth enhancing areas like infrastructure and the rest of it.
Absolutely.
Your projections on the employment outlook, driving the employment rate down below 5% to historically low levels. Do you think you might be overdoing the stimulus? Is there a risk? We read the RBA statements very carefully, the Reserve Bank of Australia, and they're very sanguine about the wage growth picture and the inflation outlook, and have signaled they're going to keep rates lower for longer. But is there a risk? You have rising housing prices, asset prices have lifted up. Might we start to see inflation, and could that derail some of your plans if interest rates have to rise? Is there a tipping point where you think you might have to pull back faster because the economy's overheating?
Well, Treasury's forecast is that inflation gets back to the band, and as you know, it's been below the band for some time. We saw a temporary spike we're going to see a temporary spike in 2021, but that's only off the back of negative inflation the year prior, as we put in place some pandemic responses like free childcare, cheaper rents, cheaper petrol, which actually saw the steepest quarterly fall last year in the consumer price index since 1931. So it's just temporarily going up, Stephen, off a much lower base, but then it steadily gets into the band. So we think we've got that right, but we'll continue to watch it very closely. With respect to the housing market, importantly, household assets are 5 times household debt. And while Australia has seen house prices rise, that's not an Australian-only phenomenon. That's a global phenomenon off the back of historically low interest rates. And people are now actually seeing their servicing costs being lower today than it has been prior because of those low interest rates. And as you know, there's a transmission effect when you get higher house prices to household consumption. And household consumption is more than 50% of GDP. And people suddenly start feeling the wealth effect. And that's quite a good thing for the economy at large. So I'm pleased when housing prices are going up as opposed to going down. And for most people, their house is actually their number one asset. So I'm comfortable where that is at. With respect to the unemployment rate, I do think this is a historic opportunity for us to drive the unemployment rate lower. And both Treasury and the Reserve Bank have said that the NAIRU is lower than 5%. In the case of Treasury, they say 4.5% to 5%. And what that will mean is that once you get that unemployment rate down, you start to see that spare capacity in the labour market being eaten into, and more competition for labour is good news for real wages.
Okay.
So that's what we're seeking to drive, more competition for labour and improvements and increases around wages as a result.
Okay, so with all of that positive economic outlook and your budget priorities, when can we expect to start seeing a move toward fiscal consolidation or fiscal repair, as you like to call it in Australia?
Well, Stephen, I gave a speech to this effect where I talked about the two phases of our fiscal strategy. We are firmly in phase one, and that is why you saw boost to aggregate demand with those measures that you and I have just talked about on the tax side, and whether it's household taxes, income tax, or whether it's immediate expensing and the like. We are seeking to get the unemployment rate back to where we were going into this pandemic at 5.1, and then even lower if we can. Then you'll start to see that transition. But as you know, the pandemic continues to rage, and this budget was developed in the midst of that pandemic. And we've seen countries like Europe, and we've seen places like Europe go into a double dip recession, and we've been very conscious to avoid the fate of other nations in that respect. And so we'll continue to be prudent with our spending, targeted with our spending, focused on delivering more jobs and lowering taxes, consistent with our political philosophy. But at the same time, one of the things I can point to is that our deficits and our underlying cash balances, our deficits come down by about 2/3 over what are called the forward estimates. And we saw an improvement of more than $50 billion in the 2021 underlying cash balance in our deficit compared to what we forecast just last October when I delivered the last budget. So we've seen a big improvement in the labour market. We've seen a significant fall in the size of the deficit, and our net debt to GDP, which, as you would know as well as anyone, is a key indicator of fiscal sustainability. Our net debt to GDP comes down every year compared to what we'd forecast last October. So I think our economic position has strengthened, but we're certainly not complacent. And that's why we said in this budget it was not a time for austerity.
Okay, that's very useful. Before we let you go, let me just ask you one question about the external environment,
Sure.
and particularly Australia's trade relations. Australia is a trading nation. 40% of your goods exports goes to China, 20% of your services exports to China, and yet you're having a row with China in the trade area, as are some other trading partners with China. Does that worry you? How are you going to address that problem?
Well, the first thing I'd say is the relationship with China is very important to Australia, and indeed it's important to both countries. It's mutually beneficial. And our largest export to China is iron ore. And as you know, China can't replicate Australia's iron ore either in quality or quantity anywhere else in the world very easily. And that iron ore has helped underpin the China growth story, which we've welcomed. It's been wonderful how China has taken hundreds of millions of people into a burgeoning middle class. And so that iron ore from Australia not only has underpinned their internal economic development, but also they're the world's largest steel exporter as well, and been a key driver of jobs in that country. So I can see China's demand for a number of our products continue. In agriculture, there's been a bit of a diversion in some of our exports to other markets. Now, China does pay a premium for some products, but our agricultural exporters have been very successful to date in identifying either new markets in Asia or the Middle East. and that's been a positive development. And in this budget, we've invested more money in assisting our exporters diversify and identify new markets. So the relationship with China is important. We want it to continue. It has been a little bit challenged as of late, but there is a mutual benefit from that relationship continuing.
Yeah, so that helps keep some of, I guess, the worst scenarios at bay. There's a mutual interdependence
Absolutely.
in many markets.
Our economies are very complementary, actually. If you look at that relationship, and obviously Chinese students and Chinese tourists have been important visitors and to Australia, and they've helped create the export income that way as well. But we want that relationship with China to continue, but at the same time, we've got some clear national interests, which we have continued to defend.
Okay, well, Mr. Treasurer, thank you for your
My
time.
pleasure.
I'm sure that is of enormous help and interest to investors, not only in Australia, but worldwide. A lot of interesting perspectives and lessons and key takeaways. So thank you. We wish you success and good luck ahead. Thanks again.
Thank you, Stephen, and thanks for your interest in Australia. Appreciate it.
Thank you.